Welcome back. It's time for Overlooked Stocks. George Tsilis, senior markets correspondent, joins us now to take a closer look at Genpact, ticker symbol G. George, shares at a 15-year high today. First of all, I can't believe 2007 was 15 years ago. Doesn't seem like it. After earnings, and of course, TD Cowen upgraded the stock to a buy. What more can you tell us about Genpact? It's not on my radar right now.
Yeah, it's generally is not. I mean, we usually talk about these, business processing and digital outsourcing companies like, Accenture and Cognizant. Infosys is just to name a few of the competitors that are larger than Genpact. But this is sort of an overlooked, value name in essentially the digital transformation and business outsourcing and operations outsourcing industry space. And they serve multiple, industry groups. That includes financial services, healthcare industry, but I think the high tech and manufacturing component of their business is really where the sweet spot is in terms of the growth based upon what they reported as a overall business. But, they deal with supply chain management and, of course, automation and analytics, and they design customized solutions for individual customers that are tailored for each needs. But if you look at their EPS and growth numbers for sales, they were actually quite good. They're actually modest, to say the least. If you look at, the EPS came in at around 91 cents. That was higher by 11% compared to last year's 82 cents. And they beat the estimate by about a nickel, which was expected to be around 86 cents. And sales came in around 8.7% to the upside, around 1.25 billion, higher than the 1.15 billion from the same quarter last year. But if you look at the guidance the company provided, they actually increased their guidance for the full fiscal year of 2025 to about 6.5%, particularly in sales for their digital tech, data tech, and AI business, which I think is the catalyst here. But for next quarter, they're actually guiding quite a bit higher to about 11%. And I think that speaks to potentially, this company, Genpact, securing multiple contracts for the standpoint of data needs, which may include things like supply chain management and manufacturing. And I think the narrative really behind this company is twofold. One, there seems to be a trend going on in all of the infrastructure names and the periphery names outside of semiconductor hardware. We've seen NVIDIA, AMD, and the core semiconductor names actually perform quite poorly over the past few weeks. You're actually seeing companies like Genpact, which essentially is the technology integration and digital transformation services industry group, really starting to gain traction. The thing about this company as well is compared to some of those peers like Cognizant or even Infosys, I mean, first off, its performance on a relative basis to some of those larger competitors is quite pronounced. The stock is higher by about 70% over the last 6 months compared to some of the others like Cognizant, which is higher by 21%, but still nonetheless, Genpact's rate of change is about 3 times that. When I looked at the comparisons, that Genpact is a much smaller company, but it's actually more profitable, both on an EPS standpoint, but also sales growth, which is around the high single-digit range. And overall, if you look at the profitability profile of Genpact as a business standalone unit or entity, they're generating about 450 basis points higher in net income margins relative to their 5-year averages. And they're doing so on gross margins that are stable over time. So the point is they seem to be doing something internally to improve their operational efficiencies. And I also think the catalyst associated with the data tech AI business, which is expected to grow in the double digits at least next quarter, is also a catalyst. And that's why I think the analysts, as you mentioned, TD Cowen raised their target to $60 from $45, because this company is really growing at a reasonable price. And I think that's important here as a standout alone company, being around $9 billion in market cap compared to some of the other behemoths it competes with, like Accenture, which is over $250 billion in market cap.
All right, so TD Cowen sees another $5 upside from here, given today's gains. And actually, Needham has a $65 price target, the highest on the street. So median price target of 57 only implies a few dollars upside. So we'll certainly keep our eyes on this one. George Tsilis, senior markets correspondent, thank you so much.